insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host for today, Stephen Irwin, investment advisor based out of our Belfast office. And this week, I'm pleased to be joined by Richard Carter, Head of Fixed Interest Research, and Matthew Dorset, one of our equity research analysts. Good morning to you both. It's been an eventful few weeks, very much keeping with the tone of 2025. And as we approach Christmas, let's hope for a quiet period to close out the year. So the UK budget is now behind us, and while it didn't bring any major surprises, it did highlight some of the structural forces shaping policy and markets. A high debt world, stretched public finances, and geopolitical shifts, which are redefining government priorities and influencing capital flows. And today, I want to discuss some of these dynamics and explore how they're impacting the investment landscape. So, Richard, let's start with global debt. Public debt across major economies has surged past $100 trillion and continues to climb. What are the structural drivers behind this persistent rise, and how does this cycle differ from previous ones?
Well, I guess, Stephen, previous cycles where you've had this high level of public debt often been associated with wars, really. I mean, particularly in UK, World War One and World War Two were obviously high periods of high spending. I mean, the problem is that most countries, and particularly including the UK, have been running fiscal deficits for a long time. And the last time we had a surplus in the UK was back in, I think, 2000 when Tony Blair was in charge. But things have changed a lot since then. I mean, there have been a couple of big, I would say, crises or events that have caused a kind of big spike in debt, certainly here, but in other countries as well. And the first one was obviously the financial crisis, which led to a lot of spending to bail out the banks. And then you had COVID as well, where there was a lot of money spent on furlough schemes and all the rest of it. So those have meant that our debt levels have ballooned. And in more recent years, as we've seen with the budget and other examples, and this is true in France and the US as well, that there's a real failure to keep control of spending. A lot of that may be due to things like welfare or healthcare or all the rest of it. But I'm afraid it's a situation that's been getting worse for some time.
Yeah, no, thanks for that. It's really remarkable to think that it was only a few years ago we had significant yielding negative debt, which isn't a big issue when you have lots of debt if it's negative yielding, and that's certainly not the environment we seem to find ourselves in now. And I know we've seen headline inflation rates come down and interest rates coming down as well. But I think because they're more elevated from previous periods that we've been used to, the old assumption that debt doesn't matter is starting to be challenged. To put bluntly, how much debt is too much debt, Richard?
That's a very difficult one to answer. I mean, often people talk about sort of 100% debt to GDP, but it really depends a lot. I mean, like you said, think about if you've got a large mortgage or something and your interest costs are very low, you can probably sustain it for a while. If suddenly your interest costs go from 2% to 5%, it's a different matter, and it's not entirely different with countries. I mean, Japan has got huge debt levels worse than us, but their interest rates, although they're rising now, which potentially could be a problem, their interest rates are still fairly low. We're paying very high rates on our debt, and unfortunately, what that means is it starts to crowd out kind of more useful public spending. You'd far rather be spending money on new airports and roads and railways and all the rest of it. That's before you even get onto the stuff that may be less economically productive, but you still need to spend money on. But unfortunately, we're spending a fortune on interest costs, not helped by the fact that some of our debt is inflation linked, which obviously has not been great in recent years. I mean, there's no one tipping point. You had things like Eurozone crisis where Italy and Spain and Greece saw their interest costs skyrocket, and it became unsustainable. They were going to go bankrupt. Until you sort of see things like failed auctions where a government might come to market and no one's interested in buying. You obviously had the Liz Truss issue where suddenly the government comes out with measures that just don't have the confidence of the markets. then you've got potentially a crisis on your hands. But you can't really say what number that is. It just depends on the whole host of factors.
And no, thanks for that. And from a political perspective, and I know you've already just touched on this, we've seen that governments are struggling to implement fiscal discipline. Obviously, the likes of the UK, the recent budget, they've had to backload some of the tax increases, and the likes of France, where they really need to implement pension reforms and are really struggling to do that. Are we entering an era where fiscal discipline is becoming politically impossible? And if so, are there any implications for equity and bond markets?
I don't think it's. I don't think it's impossible. I think. Yeah. Sorry to go on about Liz Truss all the time, but I think that episode was a lesson to not just politicians but to people in general. Really, that okay, some parts of the political spectrum might not have agreed, but a lot of people accepted that the country kind of needs to live just about within its means. The US, because we are quite reliant on overseas investors and all the rest of it. The US, because of the nature of the dollar and US treasuries, seem to be able to get away without much fiscal discipline. But that might change. And France has the benefit of being inside the Eurozone, which gives it a bit of extra stability. But I don't think it's impossible. But maybe it takes the odd sort of crisis or kind of lesson for politicians to say, look, come on, we really need to get on top of this. But even with Labour cutting spend, with a big majority, cutting spending on things like welfare has been very difficult. So it's certainly still a challenge.
Oh, thanks for that. And then finally, turning to UK fixed income markets, despite a brief post-budget rally, gilt yields remain elevated in the UK versus US and European peers. What's driving this divergence, and does it create relative value opportunities for investors?
Yeah, I think it does. I mean, we do have high yields. You can't always compare, I don't know, 4.5% yield in the UK versus a 2.5% in Germany and say that's extra credit, that's all credit risk. There's a lot more going on there. I mean, the problem is in the UK, we've had structurally high inflation. It wasn't helped by the previous budget when they put national insurance costs up, which didn't help. But we have had structurally high inflation. That's meant the Bank of England hasn't been able to cut rates. You've got much higher rates here, central bank rates here than in Europe, and that's been an issue. And rates will come down, but they're only going to come down gradually. The other thing I sort of alluded to before, the UK, the nature of the bond buyer base, kind of, people who make large purchases of UK gilts. It's changed over the years. Pension funds aren't quite so active, particularly at long end. We're much more reliant on not just private investors, but overseas investors as well to buy our debt. And, other countries have a bit more of maybe a luxury on that front. So, so it is a bit harder for the UK. It makes it all the more important the government does the right things in terms of the sort of message and getting spending under control. It does create some relative value opportunities, I think. I think UK gilts and UK credit too look quite attractive relative to other markets. My worry is that, we've got through the budget, but Starmer and Reeves's positions are perhaps a bit shaky. And you're not 100% certain that sort of 9 months from now they'll still be in charge. And if you saw a more sort of left-wing takeover of the Labour leadership, that could be a problem for investors.
Yeah, thanks for that. And now if we now switch to geopolitics, we've seen Russia's invasion of Ukraine has fundamentally altered defence priorities worldwide. NATO's renewed commitments, including ambitions to raise spending towards 3 to 5% of GDP by 2035, highlights how structural this trend has become. Even traditionally cautious nations like Germany and Japan are accelerating military modernization and spending. Matthew, aerospace and defence is one of your specialist areas. In recent weeks, there's been talk of potential peace negotiations in Ukraine, or at least a growing appetite for them. If progress towards peace is achieved, what impact could this have on the sector?
Yeah, thanks, Stevie. It's certainly been a hectic few weeks in geopolitics, and that's really manifested itself in quite a volatile period for defense stocks. So we've seen the sector trading down about 20% or so peak to trough over the last month. It has recovered a bit more recently. Personally, I'd be quite skeptical that the renewed efforts on peace are going to yield any real solution to the war. Russia's really shown no willingness to back down from its maximalist demands, and it's quite hard to reconcile that with the position of Ukraine and Europe. And certainly, the more recent news flow seems to suggest we're not particularly close to a solution. But that being said, as you ask, if we assume significant progress on peace talks are made, what does that mean for the sector? I think it's possible to construct an argument whereby a ceasefire slows the sector's momentum. So the constant replacement demand in Ukraine would stop when they cease firing missiles and artillery and consuming equipment, and an end to the conflict in Europe, and Russia supposedly being reintegrated into the global economy would arguably lessen the geopolitical threat environment and therefore the need for Europe to accelerate its defense spending. So it's possible to make that argument, and it certainly seems that's how the market is taking the news at the moment. Whenever we have discussions over potential ceasefires, the defense sector trades down. But it's not an argument that I would make. And in fact, I think the opposite is more likely. If a deal that resembles the 28-point proposal that we had a few weeks ago to any reasonable extent is agreed, I'd view that as much more of an accelerant for defense spending in Europe rather than the opposite. It would mean that Russia's been essentially rewarded for forcibly changing borders in Europe. It would leave Ukraine incredibly vulnerable to further attacks in the future, especially if they gave up the Donbass or reduced the size of their military. It'd also provide Russia an opportunity to rearm. So we've had the likes of NATO Secretary General Mark Rutte saying that Russia could be ready to attack a NATO country within 5 years. And it would further deteriorate transatlantic relations. So I think this all makes the need for accelerated European defense spending all the more pressing, in my view, in addition to the huge amount of catch-up spend required to make up for decades of underinvestment, which has been exacerbated by donations to Ukraine. I also think underlying all of this, there's structural trends which are pointing towards higher defense spending. The world is a more dangerous and polarized place. The US is increasingly focused on the East. And I think Europe is finding it can no longer rely on the US as it has previously. And certainly the new US strategy document that was released at the weekend, I think, only reinforces that. In its white paper on defense readiness, the EU said that Europe faces an acute and growing threat and that history will not forgive us for inaction. That's putting the situation quite starkly, but I think quite accurately. And I think there is a recognition from Europe that more needs to be spent. I don't think that would change with a ceasefire in Ukraine. Certainly not if the ceasefire is one that's acceptable to Russia. We've got these new NATO defense targets of 3.5% of GDP. I think that really underpins the growth that we're seeing in Europe.
Yeah, no, it's really unfortunate that it does appear to look like it is quite structural. You mentioned that this defense sector has delivered robust returns in recent years, but we're in a bit of a pullback. Where you find the best investment opportunities in the sector, and are valuations still attractive?
Yeah, the sector's performed incredibly strongly. Over the last 3 or 4 years, the sector has trebled in Europe, so significantly outperforming the broader market. That's mainly driven by this re-rating as investors are really trying to price in this period of supernormal growth to come. And unlike history, Europe is now trading at a premium to the US in the aerospace and defense sector, which is never really been the case. We have had some earnings revisions, but it takes time for companies to ramp up production, so it's been less impactful than the re-rating. So you ask about valuations, and the sector is now trading on about 26 times 2026 earnings compared to the historic average of more like 16 or 17 times. So lots is being priced in. But while valuations are no longer as attractive, we do continue to see opportunity here, given the long duration nature of the story. But it's certainly important to be selective. I think the best opportunities remain in Europe, given the superior growth outlook there, despite the higher valuations. But it's important to really dissect the company's exposures, both geographically and by product. So we would have a preference for exposure to countries where the growth in defense spending is more de-risked. So if you think Scandinavia, the Baltics, Germany, Poland, as opposed to countries in Southern Europe like Spain and Italy and Portugal, where they really feel the geopolitical threat environment much less keenly and typically have more difficult fiscal positions. In terms of product exposure, the EU published a list of key capability gaps within Europe where there's more urgent need for procurement. So areas like air and missile defense, ammunition and missiles, and drone and counter-drone systems. So I think it's also important to pay attention to which companies have exposure to those faster growth areas. So if we take all of this together, a couple of names that look interesting to us include Saab, which is Sweden's national defense champion. It has exposure to high growth countries like Sweden. It has a diverse and high quality product portfolio that spans fighter jets, counter drone systems, and man portable munitions. And it's really allowed the company to consistently outgrow the markets. It's a faster growth name than most peers as a result. And so it does trade at a premium multiple, but one that we think is still justified. And then BAE in the UK also looks interesting, I think. It has lower exposure to Europe, but has an incredibly high quality, diversified product portfolio. And it's really a name that we think should be able to generate consistent low double-digit growth well into the next decade, which is quite compelling given the more attractive valuation versus European peers. So BAE now trading below 20 times earnings. And really, that's definitely a name that exhibits this pullback that you mentioned. So shares are trading at more like 25 times earlier in the year.
Well, certainly a lot of moving parts. Thanks for that. Look, that wraps up today's discussion. Thank you both for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week. In the meantime, head over to our website at www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts on our next podcast? Simply ask them via the weekly comments page on our website. We'd love to hear all your questions. And that's it for today. So thank you, Richard and Matthew, for your time, and all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.